I would say, also delivers speeches. And she's actually very good in that. I read a number of speeches with a lot of interest. I recommend especially the last October speech on digital currencies, stable coins, central bank digital currencies, especially fast payment systems, which actually is the focus at the end of the speech. Really very insightful. So thanks for being here, and the floor is yours.
Yes. So I've been working with Benoît now for over, I guess, for a decade, starting at our respective treasuries, where we both were drafted as financial firefighters. And then I followed him into the world of central banking, where we were both working on stabilization, recovery, and normalization in our own jurisdictions. And over that time, I've developed very deep admiration for Benoît's keen insights and outstanding judgment. But just as important, Benoît always has a plan, and it's generally a good plan, and it's generally addressed to the right problem. And he generally gets it executed with exceptional efficacy and strong support, and that, in my opinion, is a rare and invaluable combination in public service. Benoît's success, I think, can be seen actually in the data. Nope. Nope. Hold on. There we go. So his tenure at the ECB was marked by an incredible turnaround in both unemployment and output growth. In fact, at the Fed, we now term that the Cœuré curve, or la courbe Cœuré, which is one of the few things that works in both languages. Benoît's research interests are very forward-looking, as others have noted, and extend well beyond the macroeconomy. When he was appointed chair of the CPMI, the global standard setter for payments issues, he doubled its output, resulting in nearly 75 reports. So you can add that to the 175 speeches. And he turned its focus to digital currencies well before many other central bankers realized these issues would be transforming our world. These issues would be transforming our world. Transforming our world. Indeed, the number of Google searches for central bank digital currencies increased sharply over the course of his tenure. And at the start of his term, Bitcoin's market capitalization was small, and there were only a handful of cryptocurrencies. But in the 8 years since then, you can see that both the market cap and the number of cryptocurrencies is now in the thousands. Indeed, the potential of cryptocurrencies and stablecoins to scale rapidly is illustrated by the accelerating rates of technology adoption and the growth of large networks. And that, I think, is the topic that I was asked to speak about. And we can understand, I think, through looking at some of these trends, why Benoît was asked by G7. Benoît was asked by G7 leaders to look at the issue of emerging stablecoins. If you look at the adoption rates of new technologies, essentially, they compress over time. So what once might have taken 40 to 50 years, landlines to reach 80% of the population later took 15 years. In the case of the internet, this is looking at the US, and most recently, smartphones and social media have achieved the same level of adoption in less than a decade. But that rapid adoption is even more evident in the payments landscape, where network externalities are extremely important. Over the course of 5 years, Venmo transactions grew over 66 times. In China, mobile payments grew over 35 times in only 5 years. And in India, over only 3 years, we've seen that kind of payment adoption going to 400 times the pace. In terms of digital currency payments projects from big technology firms that start with network advantages, they have the potential to scale even more rapidly. And because the utility of any medium of exchange increases with the size of the network that uses it, the power of a stablecoin payment system depends on the breadth of its adoption. With nearly 1/3 of the global population as active users, the Libra stablecoin project stands out for the speed with which its network could reach global scale. And that potential is leading central bankers and other authorities to revisit fundamental questions about money and payments. While central bank money and commercial bank money are the foundations of the modern financial system, non-bank private money or assets also facilitate transactions among a network of users. In some cases, those non-bank private assets may have value only within the network, while in other cases, the issuer may promise convertibility to a sovereign currency such that it becomes the liability of the issuing entity. In contrast, stablecoins aspire to achieve the functions of traditional money without relying on confidence in an issuer, such as a central bank, to stand behind the money. And for some potential stablecoins, it appears users may have no rights with respect to the underlying assets or to any issuer. So while we've seen the growth of massive payments networks on existing digital platforms, such as Alipay and WeChat Pay, so far these networks operate within a jurisdiction based on the sovereign currency as the unit of account, and balances are transferred in and out of bank or credit card accounts. We've also seen the issuance of stablecoins on a much smaller scale, such as Gemini or Paxos. What would set the Libra project apart, if it proceeded, is the combination of an active user network of more than a third of the global population with the issuance of a private digital currency opaquely tied to a basket of sovereign currencies. That potential to be adopted globally in a short period and to establish itself as a potentially new unit of account means the stakes are exceptionally high. Libra, and indeed any stablecoin project with global scale and scope, must address a core set of legal and regulatory challenges. Unlike social media platforms or ride-sharing applications, payment systems cannot be designed as they go due to the nexus with consumers' financial security. So to just give you an illustration of what kinds of risks regulators are worried about, cryptocurrencies already pose risks to the financial system. Estimated losses from fraud and thefts associated with cryptocurrencies nearly tripled over the last year alone. And in most cases, customers bear the losses. By contrast, consumers in the US and the Euro area expect strong safeguards on their bank accounts and the associated transactions. Statutory and regulatory protections mean that consumers can reasonably expect their deposits to be insured up to a limit, fraudulent transactions to be the liability of the bank, transfers to be available within specified periods, and clear standardized disclosures of fees and payments. Not only isn't it clear that comparable protections will be in place with Libra or what recourse consumers will have, it's not even clear how much price risk consumers will face since they don't appear to have rights to the stablecoin's underlying assets. Illicit finance is also a significant concern. In one industry report, research found that roughly 2/3 of the 120 most popular cryptocurrency exchanges have weak AML, CTF, and KYC practices. Only about 1/3 of the most popular exchanges require ID verification and proof of address. And that's notable since one study estimated that more than 1/4 of Bitcoin users and roughly half of Bitcoin transactions are associated with illicit activity. So there are also questions related to financial stability. Liquidity, credit, market, or operational risks alone or in combination could trigger a loss of confidence and run-like behavior. Of course, the precise nature of that risk would be driven in part by how the stablecoin is tied to an asset, if at all, and the features of the asset. For instance, a stablecoin tied to one-to-one to an individual sovereign currency would be quite different than one tied to a basket of currencies. A stablecoin built on a permission network, quite different from a permissionless network. And a stablecoin used solely by commercial banks, quite different from one used for general purpose use by consumers. Similarly, there are important implications for monetary authorities, particularly for smaller economies. There may be material effects on monetary policy from private sector digital currencies as well as from foreign central bank digital currencies. In many respects, these are similar to dollarization, aside from the fast pace and wide scope of adoption. So for all these reasons, the emergence of stablecoins is raising important questions for regulators everywhere. In the United States, the regulatory framework is not straightforward. Our current framework is based largely on whether a cryptocurrency is deemed to be a security or has associated derivative financial products, or the participating institutions are themselves supervised. Unlike many other jurisdictions in the euro area, regulators don't have authority over retail payments in the US. Moreover, the regulatory challenges are likely to be inherently cross-border in nature, which is why the G7 took this up. Cross-border in nature, which is why the G7 took this up. Because stablecoins are unlikely to be bound by physical borders, regulatory actions in one jurisdiction are unlikely to be fully effective without coordinated action elsewhere. Of course, the prospect of global stablecoin payment systems has intensified the interest in central bank digital currencies. Proponents argue that central bank digital currencies would be a safer alternative to privately issued stablecoins because they would be a direct liability of the central bank. But a more relevant question may be whether some solutions may be able to offer the safety and benefits of real-time digital payments based on sovereign currencies without necessitating radical transformation of the financial system. In the US, there are important advantages associated with current arrangements. Physical cash in circulation continues to rise due to robust demand for the dollar. And of course, as others have noted, the dollar plays an important role globally. Moreover, we have a robust and diverse banking system that provides important services along with a widely available and expanding variety of digital payment options. Circumstances where the central bank issues digital currency directly to consumer accounts for general purpose use raises profound legal, policy, and operational issues. That said, it's important to study whether we can do more to provide safer, less expensive, faster, or otherwise more efficient payments based on sovereign currency. Some jurisdictions are likely to move in this direction faster than others based on the particular attributes of their payments and currency systems, and so we are actively seeking to collaborate with other jurisdictions as we advance our understanding of the potential benefits and costs. In the US, we're actively working to introduce a fast payment system for the United States. Benoît's been very involved in the one here. In the US, we're actively working to introduce a fast payment system for the United States. Benoît's been very involved in the one here, to improve the speed and lower the cost of consumer payments. And finally, as we work to reduce frictions, one of the most important use cases is for cross-border payments, which everyone agrees are slow, cumbersome, and opaque. Authorities in many jurisdictions recognize the importance of cooperating across borders with each other and the private sector to address these cross-border frictions. So given the stakes, any global payments network will be expected to meet a high threshold of legal and regulatory safeguards before launching. More broadly, the work ahead is not easy. The policy issues that I've outlined are complex, the coordination challenges are significant, and there are few simple fixes. That is why I'm especially pleased that Benoît will continue to help us navigate these issues as the new head of the BIS Digital Innovation Hub. Thank you. New head of the BIS Digital Innovation Hub. Thank you.